Hey guys, this is Julie. We're going to walk through some different bar types and talk about, how JATS measures volatility. We run our calcs off the current open of the bar. So, like, here's a 30-day bar. So, if you measure from the open of the 30-day bar, you can see that the distribution aligns with our statistical model quite well. Now, these calcs will change because a lot of the time we're running this 30-day distribution. Let me duplicate this in a new tab. But we run it off of a daily bar instead of a 30-day bar. I have 30-day and monthly calcs on the screen on the distribution. So this is the way we normally look at it. So from a daily perspective, running a monthly and 30-day range. So here is the 30-day range, and yeah, this is a 30-day distribution. So the monthly is on a different chart, but you get the point. So now we're below the 30-day one, moving out, and we can run our tails below the distributions to catch turns, fib levels. So here's the 30-day 14 period, and here's the 30-day one on the open, and then here's, I don't want the open, let me do the close. I guess I will turn this one on. Okay, so you can see right at 1.25 times the range, the 55.65 was just below that. And so there was the dip by the dip, and then it came back up. It's pretty cool. But the monthly range, you can do the same thing on a monthly distribution. You can see that on the monthly bar itself, the market came up 1.5 times from high to low, uh, right there at 461.88. Market reached 457.37, so right below the 1.5 high to low monthly range at the monthly threes off the monthly bar. So that's extremely precision, showing you the distribution that the dealer is working in. And if we were to do the same thing with this, which is changing it to a daily bar and running the same monthly distribution on a 1 day, you're going to see that the distribution itself shifted like the 30-day did, and we're below the monthly one going out. And again, if we run these fibs below it, you'll see it's at 1.25 times the range. There we go. Right on 1.25, the monthly range, and that's where they came in. And so that was that dip. So the 30-day dip right here, actually it went down to the monthly calc. So it went from the 30-day calc, the 30-day 1.25, to the monthly 1.25 off of the daily distribution. When we run the 30-day and monthly distribution all on the same chart, you see that's how we got to the bottom of the monthly one R ball level right here, both of them, monthly one R ball. And the market went up 1.5 times on the monthly and one, you know, um, above 1.5 on the 30 day, 1 point, you know, 6.3 or something like that, 6.5, but incredible. So overshot it, and now we're bouncing back up. So if we do the same thing with this and duplicate it and change it to a daily bar, showing that R vol of the monthly range, instead of it calculating on a monthly bar open, we'll calculate on a daily bar open. So that's that daily R vol versus the monthly H vol range comparison. You can see here the the major spread putting them together, and calculating both open and close. And let's put fibs on this again. We use the same fibs. 0.25 is 1.25, the range, and 0.5 is 1.5 times the range, measuring from mean to 3. And so you can see here we came down to the 1.25. Let me put the calcs on the open on. And we double bottomed. Look. We double bottomed on the 1.25 off the 30-day range. I'm going to find the monthly open. Hang on 1 second. I mean, the best thing I did is make this indicator, but an oscillator. But then going back and here, look, putting the tails on. Look at that. So with tails, you can see how precision combining these bars together, the 30-day and the monthly range together. Wow. It just, that just is incredible. So that 5511 was support. So play around with your distributions and understand the difference that I'm trying to explain to you between the R vol and the H vol. When we get outside the distribution, like you can see your monthly um, R vol was outside the monthly distribution, that showed that range expansion that we got to the downside. When it's inside the distribution, like all the way here from November, December, January, February, March, May, June, July, August, all of that was inside the distribution. So the range never broke, right? It stayed inside the ones and twos and closed inside of it. So that's how the dealers know, where to sell the premium. Once it breaks above the distribution, then that's how the range expands. You see how it got bigger and it broke the ones, went to the twos and threes right here. So, and then here it's a huge range expansion. You can see over 1.5 times the range. Look how big the bar got. So you can use your threshold by the point level because it's the actual point level of the bar. I mean, I hope you understand that. So you can run these distributions on monthly or weekly or 30-day or 7-day or 1 day. You can mix your distributions up and try to get a glimpse of where the dealers are positioned and how they're moving their market around inside those option expirations of corresponding expirations. A monthly would go to a monthly, or um, and you can write your term structure out also to the weekly and monthly ranges. So um, here is the monthly 1, 2, 3 for the 14 period. You can add the monthly 1, 2, 3 on a 1 period to mimic that R ball daily range action. So here we put a monthly 1 and then put this back in the panel 2. There we go. So you can see here how market went up to that 1 period 1 and came back down, and then once it broke it, that's when you got, look at that huge range expansion day. And then it came back inside the distribution, tiny bar, tiny bar. And then once it starts breaking the distribution again, that's when you get the range expansion. So this is on a monthly basis. You can see the power behind this when you move it to a weekly and daily distribution. For instance, if you have your 60-minute range on top of your daily one, for instance, so you could put a daily, a 60-minute bar on your chart. Let's do that real quick. Let's put a 60-minute. I've got a little bit of a delay here with my graphics card while I'm recording. Hang on. There it goes. Alright, so we're going to put a 60-minute bar on the chart. And you could build an algo that just looked for when the 60-minute one is on top of the, or the daily one's on top of the 60-minute one. So here is your 60-minute distribution. And you could add, nest on top of it, another distribution for a daily one. That's how you build your term structure. And then put that on the same panel as the other oscillator. There you go. So you can see that the 60-minute range is inside the daily one, so you're not going far, right? But when the 60-minute broke above the daily one, like right here, you can see that that's when the range went down. So if you put like Bloodhound on your chart, and this is really what's good about Bloodhound, you can model these out very quickly. So you can put Bloodhound on your chart. Okay, so what we have here is I have the 1 period daily, the yellow line above the 3, the orange daily H vol. So this is the 1 period R vol over the 14 period H vol. And you see that when the 1 period goes above the 14 period on the daily basis, that's when the market can get those range extensions down. So I've set up a Bloodhound template to mimic that. It's easy to do in Bloodhound. You just set up, your comparison solvers, R vol over H vol. Here we go. So it's the 1 period over the 14 period. And then I can require the second part of this is you see how the 60-minute 3, which is the white line, the 60-minute 1 period R vol 3 above the daily 1. So check this out. You see how it goes below the daily 1? That is very low volatility and you're not going anywhere. But when the 60-minute one goes above the daily 1 at the same time that the daily 1 is above the daily 14, that's when you get your range extension opportunities. In an uptrend, they don't come around that often, so you could set your chart up for this during OPEX and or around a news announcement, and it's very effective. Otherwise, we can set up our template to show inside longs when it flips around. And then, like I said, you can use these distributions to help you make sure that you're in the right momentum and volatility period to take advantage of this low directional long condition. So we'll get into that more in training, but this can be used on any time frame. Okay, we can set up long vol trades going long and short, just long vol, just the slope is long, so that when you enter a trade on one particular bar, you can probably count on it getting a little bit in your direction, especially if you've got the direction right overall. But I prefer trading this inside or outside. Inside, I can clearly delineate when that condition happens, and when it's outside, I can do the same thing. Um, and I do that here. Outside range extension, just going in and taking them short. Okay. If I put just the Bloodhound logic template on it by itself, you'll see that same condition. It's right there. That's the condition. And then you can put your other, momentum or trend direction on top of it. So 60-minute above or below the daily 1 for longs, below it for shorts for sure, as well as that 1 period daily inside the distribution. So don't even try to, go short on a down bar inside this condition. It doesn't work. It comes back on top of you. See what I mean? Jelly bean. All right. I've got plenty of templates, guys. Don't panic. I can help you with Bloodhound templates. I can help you with understanding how these, bands work together. It's not bands, they're volatility. So it's basically I'm mapping volatility on time frames. All right. We'll talk to you guys later. Thank you so much. See you tomorrow.